All right. Hey, everyone. Happy tax day. I don't know if I should really call it happy. If you guys paid your taxes, congrats to you. I hope you did, because they are due today. Just to clarify, one big misconception, even if you file for an extension, taxes are still due today, state and federal, and local, I guess. So make sure you pay your taxes by midnight tonight. And hopefully your CPS filed for an extension if you are going to be filing for an extension. So here I've got a special guest with me. A lot of you already know Brannon from our previous Facebook Lives. But for those that don't know Brannon, you're one of the sharpest guys I've met when it comes to deal transition, talk about DSOs. Obviously, it's a sore topic for a lot of us to discuss, because I think there's obviously that big negative perception of DSOs, and of course, like there are times that they're not good for us. There are times when it might be good for an individual practice owner or a group of practices. So with everything that's been going around, first of all, take a minute or two to talk about tell us about yourself. Where you're located, what you do, when you started McLaren Associates.
Yeah, thanks for having me on tonight, Sunny. I live in Austin, Texas, and I've been in the dental industry for over 20 years, about a decade as a banker, and the past decade as a broker and sell-side advisor. So really what we do all day long is provide sell-side advisory services to large practice owners who are looking to go the DSO private equity route. And that really starts with not convincing anyone to do anything. It starts with educating people, right? Giving them the information they need to empower them to make good decisions with their practice. And if that means pursuing a DSO affiliation, great. We'll take the practice to market, create a competitive environment, and make sure that they're protected, they get the best economic result, and find the best fit. But a lot of times it's, maybe a DSO transaction is not the right fit. Maybe it's just a hold on to the practice, tweak it, sell it down the road, whether that be to a DSO or private buyer. So our perspective is all about educating and empower dentists to make good decisions. And like you outlined, I mean, there's a lot of noise in the DSO space right now. There's a lot of movement. There's a lot of things happening. There's a lot of fake news, but there's also, a lot of real positive things that have come to it. But it's not for everybody. And it's a very, very personal decision that I think each practice owner needs to think about and evaluate and determine, what's their why, right? What do they want to accomplish in their career and their personal life? And how does that interact with an eventual practice sale? So those are the conversations that we have day in and day out. And, we have a great reputation. Company's been around 35 years. And we love what we do.
Yeah. You started when you were 5 then.
Yeah, right. Yeah, the 21, man, coming straight out of college, went to work for a bank lending money to dentists. Never would have thought that, this would be what, I'd be doing for my entire career, but man, it's been a blessing. It's been awesome.
That's awesome. That's great. So I know with practice owners, I mean, I think there's probably not a single month goes by where we don't get a letter, hey, sell your practice to a DSO, we'll make you a sweet offer. I mean, there's so much language, there's so much processing that goes into even when you start thinking about selling your practice to a DSO. And I think, like Brandon said, if you're the type of person that likes running your business, that likes having those relationships with your patients, you really want to be in charge of any decision that you make, all of that stuff. I mean, that a DSO sale probably doesn't make sense for you, but there are a lot of people, they get to that point where they've been practicing for 15, 20 years. They get to that point where like, look, I don't want to manage my practice anymore. I'm kind of tired of the BS from, whether it's insurances and patients and employees. I mean, all of that really starts to come down on you, and you start to kind of rethink your priorities in life. You start to really think, what is the why that you just talked about? Is it spending more time with your family and thinking less about work? Or are you still in that mode where you can go, produce the highest amount you can every day, handle the business side of dentistry, and really just keep going day in, day out? And I think for a lot of people, that burnout factor is probably the biggest reason that they start thinking about offloading some of those responsibilities and thinking about how to partner with someone that's going to really allow them to focus on clinical dentistry, still make a lot of money, but feel like, hey, I'm here from 8 to 5. When I leave at 5, I don't want to think about this practice.
Yeah, I mean, burnout's a real thing, right? And especially since COVID, I think a lot of people started to reprioritize their life, coming out of COVID when it gave everybody a chance to kind of slow down, spend a little time at home with the family and think about, what do you want the next 10 years, 15 years of your life to look like? And it's become far more stressful to be a practice owner, especially a large, successful practice owner in today's environment, in the post-COVID world where the labor market's an absolute mess. I mean, that is the main stressor from a burnout perspective that is wearing out a lot of dentists. And DSOs have built infrastructure that can help support dentists on the daily. But let's not pretend like they're going to solve all your problems, right?
Mhm.
They can solve for some problems, and they can also help you de-risk, take some chips off the table, and potentially relieve some pressure. Whether that's putting away some money in a nest egg, whether that's paying off, debt and getting out from under that burden. But like you said, like I mentioned earlier, it's not for everybody, right? If you don't have a compelling reason why, FOMO not being a good reason. If you really don't have a compelling reason why you would look to pursue a DSO affiliation, just keep doing what you're doing. But for a lot of doctors, more and more every day, they've chosen to go down that path. And if you're going to choose to go down that path, you need to make sure that you create a competitive environment, you shop around, you have optionality, and you have a leverage to pick your path, to pick your partner, not just sell to the first company that walks in the door or sell to the same company that your buddy sold to just because they had a good experience. I say this all the time. If you met one DSO, you met one DSO. Every doctor has a different why, and every DSO is different. So if you're going to go down that path, you got to make sure that you align your why with the right partner and then leverage that competitive environment to make sure you don't leave any money on the table. But a lot of what we do is getting to know our clients like intimately, both from a financial perspective and as a human being, and try to figure out what are they trying to accomplish? Is this the right time? Is this the right path? And if not, let's talk about what you need to do to get where you want to be.
Yeah. And just to make sure, and so that there's no confusion, Brandon, you don't represent any DSO whatsoever. You're representing the selling doctor. You're representing the selling dentist, correct?
That's correct.
The only client that you have.
Right. We only represent sellers. It's an interesting relationship that we keep with DSOs. We're kind of frenemies, right? So they're trying to get in the door and do a deal in the dark without somebody like me at the table, representing and protecting you. But at the same time, we have to have good working relationships with DSOs, because when you come to me and decide you want to go down that path, when we go to market and put the practice in front of them, we need to have a good working relationship so that they pick up the phone and put their best foot forward when it's time for them to consider your practice and bid on it. So it's an interesting, balance that we deal with on a daily basis in, making sure that we're properly representing sellers and holding DSOs and private equity's feet to the fire when it's time to negotiate, but also keeping trust and a good working relationship with them on a daily basis.
That's awesome. Let's kind of backtrack to 2020, 2021. Obviously, when the whole COVID stuff was happening, there were quite a few dentists that are like, look, I'm kind of done with my practice. And obviously it was so hard for some of us to have our employees back, all of them back. And then as you're trying to find new ones, the frustration just kind of grew. And over the next 12 to 18 months, and it's still going on, obviously, it became harder and harder to find people to work because there's, I don't know, all this free money in the system. So there's a pretty sharp increase in the number of transactions that were taking place. And of course, the big thing that was true back then, and especially in 2020, even first half of 2022, was interest rates were very cheap. I mean, it was so easy for a lot of these DSOs to raise capital. It was so easy for them to borrow money from the banks. It was so easy to make a compelling argument that if they invest in these dental practices, there's a decent ROI that's going to make sense for them. Has that changed this year?
Not really. So to talk a little bit about what happened coming out of COVID, I mean, going into COVID, the industry had started to consolidate at a rapid pace. Private equity was very, very interested in dental, pouring a lot of money into it. There were over 100 DSOs operating nationwide. So it was a robust market. And I would say that from a seller's perspective, DSO was kind of no longer a four-letter word, and it had become a much more palatable option, as opposed to 5, 7, 10 years ago. If I brought up DSOs with most of my sellers, they would run me out of their office. So going into COVID, the industry was already consolidating at a rapid pace. As a result of COVID and the fact that dentistry rebounded very, very quickly, and many of the DSOs were on pause for 6 months to a year from a growth and investment perspective, and they have goals they have to hit within a 5-year recap cycle. Typically, coming out of COVID, you saw demand skyrocket. We went from having 100 to 125 DSOs to now over 250 DSOs operating across the country. So once private equity, they were already interested in the dental market, and then they saw dentistry rebound extremely quickly following the pandemic. They already knew it was relatively recession proof. Now it's pandemic proof. It's a rock solid business to be in. So we saw even more private equity money come into the marketplace as a result of increased demand and also increased supply, because there were doctors that were burned out. They didn't know what the future was going to look like. It was uncertain. We just went through an unprecedented event that we never could have predicted. What happens over the next 5 to 10 years? Maybe it's time to de-risk and take some chips off the table. So you had a lot of people come to market to sell their practices, and then a ton of demand and a ton of capital, and that resulted in valuations increasing significantly. I would say on average, valuations increase anywhere from 1 to 2 turns of EBITDA coming out of COVID. So a practice that maybe would have sold for 5.5 times EBITDA pre-COVID is now trading at 6.5 to 7.5 times. But then we saw interest rates begin to skyrocket, and we started to evaluate, how is that going to impact the market? How is that going to impact valuations? And the reality is that the ROI that DSOs and private equity have been generating over the past decade was so robust that even interest rates doubling, yes, would it eat into their ROI? Absolutely. But when they're generating anywhere from 40 to 70, 80% ROI, a 5% increase in interest rates, it doesn't force you out of the marketplace. It's just more of an inconvenience than anything. The thing that we were more concerned about that is now played out is a lack of availability of capital. So we were worried about banks beginning to pull back from a leverage perspective. The way private equity grows a DSO and the way they create arbitrage, the way they create return, is to lever the business, to borrow cheap bank money, now more expensive bank money, to fuel growth, to fuel their acquisition pipeline. And what we've seen over the past 6 months, as I expected, is banks have begun to pull back. So where they were allowing private equity to borrow money at, let's say, 6 to 7 times EBITDA, they've now pulled back. Some of the banks have pulled back and now are only allowing private equity to borrow at 4 to 5 times EBITDA. Well, if valuations are still at 7 times EBITDA, I used to be able to fully lever that investment. So if I was going to go buy a practice at 7 times EBITDA, I could go to my bank and they would fully fund 100% of that acquisition. I didn't have to come out of pocket as a private equity investor with any cash. Now, if the bank pulls back and is only lending 5 times EBITDA on that same acquisition, I now have to come to the table with 2 times EBITDA in cash. Those DSOs that are not well capitalized now have a problem. They cannot continue to grow because they don't have enough dry powder to fund the delta between the purchase price of the practice and what their bank will lend. So as a result, we've seen quite a few DSOs that are not well capitalized. We're counting on their banking partners to continue to lend them money at big EBITDA multiples, go to market to recap. They have to look for a new investor that has plenty of dry powder and a new banking partner. This is not really the time that you want to be going to market to recap. So we've had some DSOs that have kind of entered a holding pattern, that they haven't hit a successful recapitalization event. Their banks have tightened up on them. Their private equity partner no longer has any dry powder. So now they have to actually operate the business that they built for the next year or two until hopefully the market improves, interest rates come down, banks loosen up, and they're able to recap. Well, a lot of these DSOs were more in the aggregate and flip game than they were in the aggregate and operate game. So now a lot of them are being tested from an operational perspective, and the institutional investors on the back end that buy these platforms are starting to pay attention to sustainability and operations. Same store sales growth has become a big talking point when you're talking about a DSO platform that's looking to recap and sell to the next investor. It's always been a big talking point in the public markets, right? In the stock market and NASDAQ. Now it's becoming a talking point in the private equity world. So how good of an operator are you? Is your deal structure sustainable? Are your doctor partners vested? And if those answers aren't positive, you're going to have a hard time recapping. So there's kind of a reshuffling of the deck right now. A lot of what we're doing is trying to keep track of, who has a sustainable business model, who was built to operate long-term, who's got capital, who's got a strong banking partner, who can actually perform on the LOI they put in front of our client. And there's been quite a bit of movement in the marketplace from that regard.
So you mentioned over 250 DSOs out there now. How is this number pre-COVID?
Pre-COVID, I would say there was somewhere between 100, 150. So
Wow, so that's a massive
I would
increase.
estimate, 100 more DSOs have been formed,
Yeah.
over the past few years.
Talk because there's also a lot of these kind of DSOs that shouldn't even be called DSOs. I mean, they don't really have any operations. They're just kind of these shell companies, I guess, if that's what I should be calling it, where they just kind of group a bunch of practices together and they say, oh yeah, we're so-and-so DSO, but each person's really operating their own business and own practice. Is there really any reason to actually even do that? I mean, they're basically hoping that they're going to sell to some larger DSO down the road. Is that basically it?
Yeah, so that concept is what we call like the co-op roll up, I'll call it a gimmick. And that is, hey, you're going to join my co-op, you're going to pay a fee to join, and you're going to pay some ongoing management fees, service fees, whatever you want to call it along the way. And as a result of bundling your practice with all the other practices in my group, your practice might be worth 6 times EBITDA on its own, but as part of our group, which is going to sell collectively to one buyer, we're going to sell for 10 times EBITDA. The reality is that the dumb money has left the market, and that might have been possible to pull off, a couple of years ago, before we entered a regional banking crisis, before interest rates went nuts, before a lot of the storm clouds started to develop, economically, where there were multiple DSOs talking about IPOing. Back in that day, that concept might have been possible to pull off, but in today's environment, it's not going to happen. So we've seen multiple roll-up gimmicks, co-ops promise their doctors amazing results, 10, 12 times EBITDA as a result of joining the group and paying some fees along the way, not deliver a transaction. And now we've been preaching this for, a couple of years now, and we're finally starting to get those calls from the doctors that are starting to recognize that they've been defrauded, for lack of a better word, and they're ready to get a transaction done. And we have to kind of re-engineer their thoughts and their expectations and show them what's really possible in the marketplace.
Are some of these doctors legally kind of stuck with some of these groups, or
So most of the contracts you can terminate at any time. I think there's two main issues though. One is it's hard to admit when you've given somebody 50, 60, $70,000 and bought into a concept that wasn't real. It's hard to admit defeat, right? And it's hard to admit that you've been defrauded. And by exiting that venture, that's what essentially what you're admitting, right? And that's hard for a lot of people to take that hit and come to that realization. The other thing is that a lot of these groups have what's called tail coverage. So anybody that they've discussed selling the co-op to is covered in tail coverage. So if you break away from the group and then attempt to sell your practice to one of the groups that they discussed the platform with during the term of your engagement, the term of you being part of the group, they're going to earn a commission, and typically a substantial commission.
Oh, wow.
I've seen 10 to 20% of the sales price of the practice. So what a lot of doctors don't understand is the proprietors of these co-ops, of these roll-up gimmicks, are out in the marketplace trying to pitch this snake oil to private equity and DSOs, but they're smart. They're passing on it. They're saying, I'm not interested in that. That concept is not palatable financially to my organization. But then they go on the list as a protected buyer under the tail coverage. So we just listed a practice that actually came out of one of those groups. And we got a list of the buyers that were covered through tail coverage by this co-op that had been trying to shop their platform to the broader marketplace. Well, there were only 6 buyers on the group, which is kind of on the tail coverage list, which is kind of embarrassing. They had been shopping it for 18 months and only had 6 protected buyers. I mean, the day we go to market with our clients, it's in front of 15 to 20 DSOs. How you could only put it in front of 6 buyers in 18 months is bizarre to me. 3 of those buyers, though, are legitimate buyers. And if we had taken that practice to market in our normal process, we probably would have gotten bids from those buyers. But because that practice was taken to market as part of one of these, I'm going to coin a term on the Facebook Live tonight. I'll call it a DSFO, right? They call themselves DSOs. They're not. They're not engineered anything like a DSO. So we've heard the term duct tape DSOs. Tonight, my new term is DSFOs.
Awesome.
So now we've got 3 buyers that are legitimate buyers that we can't take that practice to. It basically erodes part of the legitimate part of the marketplace that would have otherwise bid on this opportunity had it been presented in a proper context.
That's wild. Because I mean, I've gotten some of those letters and you're just like, what do you even think about something like that? But I'm glad you brought this up and we're talking about this because I think obviously a lot of people get fooled by this and people should hear this, listen to this and realize that it's nothing but just nothing that's going to result into real dollars at the end of the day. And you're going to be paying $50,000 to $100,000 along the way.
At the end of the day, here's who wins: the person that set up the group, because they bleed you dry over time, right? Pay $20,000 to join the group. I'm going to charge you $1,000, $2,000 a month with the promise that this amazing transaction is going to come. Honestly, it doesn't matter if a transaction comes or not, because they're making money along the way, regardless if they're successful in pulling off the concept. Look, I'll put it this way. I interact with as many or more large practice owners on a daily basis than anybody because of the position where we sit in the marketplace and the service that we provide. If that roll-up gimmick was palatable to private equity and to DSOs, I would be doing it all day, right? But it's not. So that's why we don't pitch it to our clients, because we know it's not a viable transition option. And I'm in the business of doing the right thing for dentists and being here a long time. These people that are putting together these groups are in it for the short term, and they don't really care what happens to their reputation, once this house of cards all falls apart.
Right. Makes sense. Thank you for that. before we jump into some of those case studies, because I know you're going to talk about some of the recent transactions from that you guys have completed and some of the ones that you've seen, can you just kind of do this basic elementary education for us? What is an EBITDA? What is a recap event? Just talk to us about some of those things, because I know you're going to mention those words quite a bit tonight.
Yeah, absolutely. So, I mean, EBITDA is essentially absentee owner profit. So if you take revenue minus overhead, and we're talking about real overhead, take out all, depreciation, amortization, interest expense, personal discretionary expenses, and any non-recurring expenses.
Back out all those Costco purchases, right?
Yeah, absolutely. So that's a big part of what we do, is look for all those non-recurring expenses, all those personal expenses you're running through your business. And that's not real overhead. So we add that back to the cash flow. But revenue minus real overhead minus doctor compensation, so a fair market doctor wage. If we're talking about a general dentistry practice, you're typically talking about 30% of doctor collections. That's an overhead expense. So revenue minus overhead minus doctor compensation equals EBITDA. EBITDA is essentially the cash flow of the business that's available for the absentee owner, for the investor. And it stands for earnings before interest, taxes, depreciation, and amortization. Does that make sense?
Yep, absolutely.
When we talk about a recapitalization event, essentially what that means is most DSOs are backed by private equity or a family office, some type of, let's call them institutional investor, and they're typically on a 3 to 5 year window. Their goal is to increase the size of the company through acquiring practices and achieving same-store sales growth, both in top-line revenue as well as leveraging economies of scale to drive down cost. And within that 3 to 5 year window, sell the DSO to the next investor, who is then going to repeat the cycle and look to grow the business even further and do it again. So at the time that the financial partner sells the DSO to the next investor, that's called a recapitalization event. And at that point in time, the net proceeds from the sale are distributed to the investors in the private equity firm, as well as any doctors that hold equity, whether that equity is at the joint venture practice level or at the holding company level. So when we talk about equity, there's typically two forms of equity. There's JV equity, joint venture equity, that's equity held at the practice level. And then there's holding company equity, stock in the actual DSO in the parent company.
Perfect.
Any other terms you'd like me to hit before we?
Yeah, no, I think those two are the main ones. Obviously, the buyer is the DSO, the seller is the selling dentist. We talked about that. Yeah, no, let's jump into the actual sales. What the process is like, but what have you seen? What kind of multiples are people getting if they were to go out on their own and say, look, I really want to try to sell this to the next dentist that's graduating, versus, hey, maybe I'm going to consider selling this to a DSO and become part of that.
Yeah, so one of the driving factors why a lot of people, especially with large practices, are going the DSO route is not only for administrative support and infrastructure, but also because the delta between practice valuations in the private buyer world and the DSO world is substantial. Typically a practice is going to sell in the private buyer world for anywhere between 70 to 90% of annual revenue, where in the DSO world, it's not a function of a percentage of revenue, it's a function of a multiple of EBITDA. So DSOs don't really care about how purchase price interacts with revenue. They really care about EBITDA and applying an appropriate multiple to that EBITDA. Most practices are going to trade anywhere from 5 to 8 times EBITDA. As practices get larger and start to become, platform investments, as private equity and DSOs refer to them, these are practices with EBITDA of 2 million plus. Those multiples are going to ratchet up, and they could hit anywhere from, 8, 10, as high as 12 times EBITDA. Here's what we're currently seeing in the marketplace, and then I'll hop into some specific examples. We're seeing some constriction in the market at both the low end of the market and the high end of the market. So what does that mean? That means that practices, platforms, these are typically multi-location practices with EBITDA of 5 million or more. Those used to be highly sought after and trade for crazy multiples, like 10 to 13x. We are seeing less demand and lower multiples in that realm, and that's primarily a product of the banking crisis, right? It's primarily a product of the fact that less leverage is available out there, and those investments are very difficult to cost average down, over the life of the recap cycle. Because you can imagine if you paid 12 times EBITDA for 5 million in EBITDA, when you could have done more transactions, but bought that same 5 million EBITDA for 6 times EBITDA, buying more of smaller practices,
Right.
your arbitrage is going to be much, much higher on buying the smaller practices at the lower EBITDA. And when you're talking about buying 5 million in EBITDA for 10x, you're talking about a $50 million transaction. That'll make banks pucker up a little bit, right? It'll make them get a little bit nervous about extending that much capital on a single platform, a single investment. So we're seeing the market constrict a little bit on the really, really large platforms. And then we're seeing the market constrict a little bit on the smaller practices. So practices with revenue of less than 2 million, with EBITDA of less than 5 million. We're seeing less demand for those practices, and we're seeing multiples start to come down a little bit and start to kind of more normalize to where they were pre-COVID for those type of opportunities. Where we're seeing the most demand and the highest multiples, relatively speaking, is in the range of 3 million in revenue, call that 600,000 in EBITDA, up to 5 to 7 million in revenue, 1 million to 1.5 million in EBITDA. In that range, that 5 to 600,000 in EBITDA up to about 1.5 million in EBITDA, multiples are as strong as they've ever been, and demand is as strong as it's ever been. So a few examples for you that I wrote down before we hopped on the call tonight. And I'll just walk you through, some high-level details about these practices. These are real clients, deals that have closed over the past few months. They were our clients. We took them to market in a competitive bid process. We had one in the Philly market, younger doctor. He was right around 50, and he was looking to de-risk, take some chips off the table. He liked the idea of investing alongside private equity and the wealth creation opportunity associated with, having stock in a DSO as opposed to just equity in his own practice. Single location, multiple docs, fee for service, PPO practice, 10 ops, revenue of 3.9 million. So an EBITDA of 975. So kind of in that sweet spot that I just talked about, right? The middle of the fairway, where we're seeing the most demand. With that opportunity, we saw 10 offers, with the highest offer being almost $10 million, almost a 10x. That's strong. I mean, a 10x on a practice with, 4 million in revenue and EBITDA of right around 1 million. That's phenomenal.
And how many doctors was this? How many?
This practice had 3 doctors.
3 docs. Okay.
Yep. 3 doctors doing about 4 million in revenue. EBITDA of just under 1 million. 10 offers, highest at 9.7. Our seller accepted an offer at 8.7 million. So that was a 8.25 EBITDA offer. Why did he go after the lower offer, right? It was basically $1 million lower than the top offer, because fit matters. Okay. And I think it gets lost on a lot of people. They think price is the only thing they should be thinking about, but fit and deal structure and the people behind the platform that you're going to be partnering with, that you're going to work with on a daily basis, that matters as much as the initial valuation. So it traded for 8.7 million. That's an 8.25 EBITDA multiple. One of the reasons that our seller gravitated towards this particular buyer was they were a stronger emerging, that they were a smaller emerging DSO. So they had 12 locations. and they were very well capitalized. He believed in their vision, and he wanted strong upside on the holding company equity. So it was a holding company model. He took about 5 million cash at close. He had $1 million holdback that paid a 10% interest rate. And then he had $3 million in holding company stock. So he rolled 3 million of the value of his business into stock in the DSO. And because this is a smaller emerging DSO, the arbitrage opportunity on the stock is massive. So he could, if they're successful over the next 4 to 5 years, see a 5 to 7x return on that holding company stock investment. So that $3 million could become worth 15 to 20 million. That's what you get when you invest in a small DSO that's on the way up early in the life cycle, of their platform.
So should you go for a DSO that maybe not even has had any recap events potentially? Because I mean, is the potential the highest for one of those DSOs?
Risk reward, right? So if you're risk averse, the answer is probably no. But if you're somebody who likes a high risk adjusted return, and you feel strongly about the people behind the platform and the financial sponsor behind the platform, the answer could be yes. For this client, the answer was yes. And it's funny because when we first started working with this client, he told us that his goal was to take as much cash at close. He wanted 80 to 90% cash at close. He had a couple of offers that were aggressive on cash at close, but he ended up, through meeting everybody in the marketplace and meeting this particular company, completely changing his mind and saying, I believe in what these people are building. I want to be a big fish in a small pond. I want to help drive the culture. I want to help drive the growth. And I'm going to do the opposite of what I initially said. I'm going to take less cash at close and make a significant investment in stock in the holding company of this DSO and bet on their future, because I think their future is bright and I like the upside. So the smaller the DSO, or the earlier they're at in their evolution or in their recap cycle, typically the higher the potential return on the equity. The larger they are, the more muted the return. The later in the recap cycle, typically the more muted the return. So it's all about, how risk averse you are, what your why is, and the people you meet along the way. It's amazing though how often clients come to us and say they want one thing, but once they see the landscape and they start to meet the people and see the offers and the different deal structures, a lot of times their preferences change remarkably throughout the process.
Right. What are some red flags that you should be looking out for when you're looking at some of these deals? Obviously, making sure you have proper representation, which makes sense. But let's just say you're presented an offer. What are some potential red flags that you should be even looking at?
Well, first of all, you need multiple offers, right? So that you can compare and contrast. Not only the economics from a valuation perspective, but also the deal structure, the infrastructure, the story, and the pedigree of the people involved, right? If you only talk to one, you have no perspective whatsoever. And I cannot tell you how often doctors only talk to one DSO. This particular doctor was already talking to a couple of DSOs, had offers on the table before they engaged us. And that's pretty much common with all the examples I'm going to go through tonight. So I think that we give our clients 25 questions that they need to ask as they start to interview DSOs. And a lot of it comes down to, one, what is your why? What are you trying to solve for? Okay. So if it's purely economic, then your focus when you ask questions is going to be on the pedigree of their financial partner. When was their last recap? When's their next recap expected to occur? What's the projected return at recap? What's the valuation on the front end? How much equity can you liquidate at recap? You're going to be really, really focused on all the financial aspects of the sale. And look, for everybody, the economics are important. But for a lot of people, the why involves infrastructure, support. And in that regard, you need to be asking questions about how do you make the practices that you acquire better? Here are my pain points. How are you going to help me solve them? Do you recruit? What kind of benefits packages do you offer to help attract and retain personnel? What does your infrastructure look like? Do you have a headquarters? If so, how many people sit at HQ? What departments do you have? So if your goal is to get support and alleviate the management burden, you better partner with a DSO that's got robust infrastructure. Some of these DSOs have absolutely no infrastructure. So if your why is to get administrative support and you partner with a DSO that has no infrastructure, maybe because they made a slightly higher offer, you're going to be miserable, even if the economics were slightly better on the front end. Also, I will tell you that in today's environment, if you are infrastructure light, you might be in trouble when you go to recap, because buyers are evaluating whether you truly have a sustainable platform that can continue to be scaled and operated effectively at scale, or are you more of like the duct tape DSO that was in this for the quick flip?
So as the seller, are you allowed to ask for their financials to kind of figure out if they're actually well capitalized or if they're really telling you the truth?
You can. So I will warn you though, the financials for most private equity backed organizations are relatively murky, right? You're not going to necessarily be able to tell how financially sound they are. It's more nuanced than just getting their P&L and diving through it and trying to figure out what their EBITDA is and how leveraged they are. You can ask the question, so you can make the request, and you can ask general questions about how leveraged they are, who their private equity backer is, what they're able to borrow capital at, what multiple their bank is lending at, where they cost averaged across the platform today. But unfortunately, because there's not a ton of transparency, you are going to be relying on a lot of the data and the assumptions that they give you to make a decision. And I think that's where a lot of it comes down to: who are the people involved? Do you trust them? Have they been successful in their career up to this point? How successful has the private equity firm that backs the DSO been in dental or in other healthcare verticals? Talk to doctors that have partnered with this group. What was their experience like? Talk to doctors that have been with them for a few years, and talk to doctors that have been with them a few months. And try to get as much perspective as you possibly can. It's not perfect. You're not going to be able to cross all the T's and dot all the I's and know without a shadow of a doubt that everything that this DSO has told you. You just need to get as many data points as you possibly can. And if there's consistency across all those data points, then you're going to have some comfort that you're in a good place. And we try to we spend an inordinate amount of time talking to DSOs on a daily basis and trying to vet them ourselves and figure out who we trust, who we don't, who we think is built for sustainability, who has the operational pedigree to be successful long-term and hit a recap. And we try to only put those that we feel good about in front of our clients to begin with. And then we've got a process to allow our clients and their advisors to vet those buyers themselves.
Okay, no, that's good to know. Thank you. Do you know, this might be, I don't even know if this is the case right now, but are there DSOs out there that are potentially on the brink of bankruptcy with essentially potentially, I guess, capital calls from the banks, and then they just saying like, hey, look, we want our money back? And are there situations out there?
I'm sure there are DSOs that are in duress, right? We are not currently, to my knowledge, interacting with any of those DSOs. Now, there are DSOs that I described earlier that have they've exhausted their capital with their current private equity partner and their current lender, and they need to take on a new financial partner before they are able to grow further. The problem with that scenario is, in order to recapitalize, in order to take on a new financial partner, you need to show that you've got a pipeline of acquisitions that you can execute on and continue to grow post recap. So what's happening is we're seeing this. There are DSOs that we know that are currently dead in the water without capital that have to hit a recapitalization event in order to close on new acquisitions that are actively bidding on practices.
So
With the hope that they'll be able to hit a recap and actually close those deals.
are there private equities out there that are actually forcing these DSOs to recap also to just basically say, look, we want to cash out, we're done, we want you to recap and move on?
Yes.
Wow.
Yes. It's
And
an
is that
interesting time to be in this
what
market.
percentage of the investment that the DSO has comes from a bank, a lender from the banks, and maybe it's a regional bank or big banks versus how much of that comes from private equity? Do you know? Does this differ quite a bit, or is there like a standard kind of protocol out there?
There's not a standard, but I can tell you that it's substantially bank funded.
Oh wow. I thought it was probably
Substantially.
going to be the other way around.
No, it's far more levered than it is. The way you create substantial arbitrage in the private equity world is to heavily lever the business.
Mhm.
You raise a fund, whether it's 20, 30, $40 million, you deploy that fund and then lever the rest. So if you're 50 million in EBITDA, cost average at a 7x, you've invested $350 million in that platform.
Yeah.
And the initial fund you raised was probably 20 to 50 million.
Wow.
That's how levered you are. So out of that 350 million that you've invested in the platform, 300 million of it is likely bank funded.
So private equity is not willing to lend. Well, I guess what I mean is like they might say, okay, we'll give you, we'll buy a 20% stake in your DSO, but we're also going to give you a $50 million line of credit.
The problem with the line of credit in the private equity world, that's actually investor cash.
Yeah.
So the more cash you invest, the lower your returns. It's much better to invest the bank's money
Mm-hmm.
and leverage that than it is to leverage actual investor money. The way you get these juiced up returns in the private equity world is to use leverage rather than cash.
Yeah.
So the more investor cash you use, the lower your arbitrage. The more leverage you use, the more of the bank's money you use to grow, the
Mhm.
higher the arbitrage.
Yeah.
Does that make sense?
Yeah, absolutely. Man, this stuff is pretty interesting. Can we run through another example?
Yeah. So I'll run through an example in New England. This was a female doctor. She had a young family, and she had a very, very successful practice. 4 docs, PPO fee for service, 13 operatories. Practice was doing 4.2 million in revenue, EBITDA of about 950,000. So numbers wise, kind of similar to the example that I gave you last time.
Mhm.
But her goal was to alleviate the management burden. She was pretty stressed out with the labor market and staffing. She wanted to free up some of her time to spend more time with her kids.
Mhm.
And she felt that taking on the right DSO partner that had the infrastructure to support her, what was the right way to go. So we took the practice to market in a competitive bid process. We had 9 offers on that one. The winning bid was at 7 million. So it traded at a 7.3 EBITDA multiple. She chose a joint venture structure. So the first deal we talked about was a holding company structure, where it was about 70% cash at close, 30% rolled into stock in the holding company. This particular example was a joint venture structure. It was a 60-40 deal. 60% cash at close, 40% retained within her own practice. So she's truly a partner in her own practice post-close, and she will receive ongoing pro rata net income distributions, commensurate with that 40% equity. And then she'll have the opportunity to liquidate half of her joint venture equity at the next recapitalization event. In this particular situation, the next recapitalization event was projected at 24 months from closing. And we suspect that DSO will trade for somewhere around 15 times EBITDA at recap. So if she sold for a 7.3 times EBITDA multiple on the initial transaction, she will essentially double the value of her equity by becoming part of this DSO and participating in the next recapitalization event at a 15 times multiple.
And just potentially just 2 years.
In 2 years.
Wow.
Yeah. So and it's important to distinguish between the holding company model and the joint venture model. So with the joint venture model, where you have retained equity within your own practice, and you're going to sell typically half of that retained equity at recap, where you enter the recap cycle, whether you enter in year 1 and you've got to wait 4 or 5 years to the next recap, or you enter in year 4 and only have to wait a year to the next recap, your return is the same in a joint venture model, regardless of where you enter the recap cycle. You know, you sold for 7x on the front end, the DSO trades for 15x, you get that 15x, you get the full lift, regardless of where you enter the recap cycle. In a holding company model, it's completely different. Where you enter the recap cycle is dependent on what you're going to pay for that stock in the holding company of the DSO. So if you enter the recap cycle early and you have to wait 4 or 5 years before you exit that stock, you're going to pay a lower price for that stock and have a higher return. As opposed to if you enter the cycle at year 4 and only have to wait a year, you're going to pay a higher price for that stock, because in a holding company model, the stock is marked up over the course of the recap. You're going to pay more later in the recap cycle for that stock, so therefore your return is going to be muted. Time value of money, it makes sense, right? If I have to wait 4 years to liquidate a stock, I'm going to require a higher return than the guy or girl that only has to wait a year.
Makes
So
sense.
you can imagine that we're in a scenario where we're comparing multiple offers. Some are in joint venture, some are in recap. Each DSO is at a different point in the recap cycle. It can get pretty complicated as far as like weighing which offer is better. And a lot of that comes down to, what are the goals of the client? If the goal is to take as much cash off the table as quickly as possible, we might want to go with the DSO, everything else equal, that's closer to the tail end of the recap cycle as opposed to the beginning of the recap cycle. So there are an endless amount of questions you have to ask if you want to do this right, especially when we're talking about there's 7 to 10 DSOs at the table in every deal.
Yeah, definitely. What about for a person that has one practice, solo practitioner, maybe they're doing 1.5 to 2 million, 50% overhead, 60% overhead. So they're making good money, but they also want to maybe cash out, move on, and potentially partner up. Are there any opportunities for those people? Because there are quite a few people out there.
There's a lot
that break up their practices to those levels, but then they kind of feel stuck because it's not big enough to basically get what you're talking about, but it's a very, very comfortable lifestyle for them.
Yeah, I'm glad you asked the question. So a little bit smaller practice, right?
Mhm.
One doc, maybe 1.5 doc, full-time, maybe one part-time associate, doing 1.5 million to 2 million. We sell a ton of practices that fit that profile.
Yeah.
In that scenario, you're probably not going to see these like crazy, 200, 300% of revenue offers. But we're still achieving offers in the 5 to 6.5, 7x range for those types of practices. The smaller practices are typically going to trade to one of 2 types of buyers. It's either going to be a regional buyer, somebody that's got a footprint in that area already, in that geographic area, and is building out, a robust geography of practices that kind of fit that profile. So they might have, 10, 15 offices in the same metro area that are all doing 1.5 million to 2 million. The joint venture buyers also like those type of practices. They're not a home run from an arbitrage perspective. They're a solid double. But if you hit a lot of solid doubles, it helps you diversify your portfolio and grows your reach. So we see those practices typically move to either a DSO that's got a footprint in that geography, or a joint venture buyer that's going to do a JV 60-40, 70-30 type deal, kind of like the second example that I described. You're on. there are plenty of opportunities out there for those practices. I would say once revenue dips below 1.5 million, that's where it gets a little bit harder, right? Because EBITDA is difficult. It's difficult to generate substantial EBITDA when you've got revenue below 1.5 million. And most DSOs would prefer to have multiple providers in every office, whether now or at some point.
Makes sense, yeah. And then a typical transaction, what are the terms like in terms of the doctor having to stay at the practice? And that's probably the biggest question, because a lot of times, we kind of value, okay, if I sell to a private buyer, you can choose your terms and say, look, I'm going to maybe become your associate for 1 to 2 days a week, or I'm going to sell and be done and not pick up the handpiece at all. But with DSOs, I mean, it is a little bit different. It is where you're required to stay for the most part. How does that typical time period work like?
Yeah, so with a private buyer deal, like you explained, better or worse, right? You typically have the ability to exit, at the point of sale or shortly thereafter.
Mhm.
For a lot of doctors that want to sell and continue working in their practice, that's not attractive to sell to a private buyer, because the reality is that if you don't get along with them, or there's not enough dentistry to be done, you're going to be out the door sooner than later. So for a lot of people, a private buyer is not a fit because they're not ready to go. And that's a huge risk in a private buyer deal, that the private buyer is going to let you go maybe sooner than you were ready to exit. In a DSO transaction, you're typically going to be required to commit to stay on for some period of time post-close. It used to be just 2, max 3 years. But I will say, as DSOs have started to realize that doctor turnover, especially founder turnover, is their Achilles heel. And when everybody's focused on same store sales growth, making sure that the practices they buy don't move backwards, the last thing you want to do is have the risk that the provider's going, especially the founder, is going to exit the business before you get to the next recapitalization event. And that practice is going to move backwards as a result. In an ideal world, every DSO would prefer for you to commit to stay on for 5 years. 3 years has become kind of the minimum, with 5 years being ideal. The difference, though, the post-closing commitment has increased, but what you have to commit to has changed. Back when it was 2 or 3 years, it was like, you've got to work this many number of days a year and you've got to produce at this level, or there's some type of penalty. Now, you don't have to be the person to work chairside. The DSO doesn't really care who's doing the dentistry as long as they're competent, right? All they care about is that the financial performance of the business is same or better on a go-forward basis than when they close the transaction, irregardless of who's working chairside. So for a lot of our clients, they're like, I only want to practice for another 2 years, or I only want to practice for another 3 years. Like, that's totally fine. As long as you will commit to have some type of vested interest in the business for 5 years, you don't have to work chairside. You don't have to physically be there. As long as you backfill your production with competent associates and the business continues to perform at a high level, you don't have to step foot in the office with most of the DSOs. That's really what's changed, is DSOs have allowed a lot more flexibility in regards to the seller working chairside, but they've increased the post-closing commitment as far as the seller having some vested interest in the business.
But how easy is it to find associates that are, obviously you're going to build competency over time, but how easy is it to find associates that are going to stick around, and the ones that know how to produce? I mean, the ones that know how to produce, they're itching to start their own practice, buy their own practice. So is there a happy medium with DSOs approaching? I mean, obviously we heard about, is it Rick Workman that is basically a big sponsor of a dental school that's going to be opening up in North Carolina. I don't know if that's the right word, sponsor, but he's donated a lot of money, so.
I mean, he kind of owns it from what I can
Yeah,
tell.
basically
Yeah.
owns it. So
Yeah.
I guess, what does that landscape look like, with the associates? I mean, what kind of things are they doing? Are they doing things at the dental school level, or to basically get people to come work for them?
Yes, I mean, DSOs have one of the first functions that a DSO will build out in its infrastructure is recruiting of doctors. Doctors first, staff second, typically. The doctor turnover is their Achilles heel, right? Without the providers, they can't be successful. And they know that they've got aging providers within their organization that they're going to have to, backfill at some point. So they're recruiting from dental schools, they're recruiting from local dental societies. They're doing everything they can to create an environment to attract and retain associates. We're talking guarantees, we're talking robust benefits, CE, and from the perspective of you worrying about recruiting that associate who's going to backfill your production, if you partner with a DSO and you express that your goal is to wean yourself away from the chair and eventually bring in an associate, they have the capability to help you do that and to help recruit. They're going to want your help in the process, but they all have a robust recruiting function. And if you have a successful practice, a good environment, a good team, a place where a doctor can walk in and produce at a high level and make a good income, I mean, if you build it, they will come. And the reality is that we have a change in demographics, moving to a far more female demographic. A lot of doctors that they want the income, but don't want the responsibility, don't want the debt, don't want the headache. That goes along with the millennial demographic as well. So the labor force is out there. If you have a premier practice, you should be able to recruit a premier associate.
Yeah, no, I agree. This is actually a really good question. Obviously, there are some very, very successful practices, but there might not be in your major metro areas. Some of these might be kind of in these remote areas where you might be the only dentist in town. Are DSOs attracted to some of those practices? Because on one side, the profitability index is huge, but on the other side, you can have trouble finding doctors to work there. And what you just said, doctors first, staff second. So, you find the doctor and then you still have to worry about the staffing and that kind of stuff. So are DSOs attracted to some of those practices?
Yeah, it's situational, but we've sold plenty of practices in rural areas. And I think you said it right. A lot of those practices, the overhead, structure is amazing. They're insanely profitable compared to their peers in the metro area. But they do have some challenges in regards to recruiting doctors and recruiting talented staff. I will say that the most aggressive buyers in rural areas are typically joint venture buyers, where the doctor is going to retain equity at the practice level. They want to know that they have a vested partner at the practice level that's going to help them continue to run the business, recruit, and just assure that the business performs post-close. So most of the time in those rural markets, the most aggressive buyers are buyers with a joint venture structure where they're going to buy 60 to 70% of the practice. You're going to retain 30 to 40% of it. They've got a vested partner, boots on the ground in that rural locale. Does that make sense?
And then, yeah. And then those DSOs, do they have a preference of fee for service practice or PPOs in those kind of areas, or do they not care as long as it's making money?
They don't really care. I mean, there's not a lot of sensitivity around fee for service versus PPO. We work with both types of practices. We're selling a multi-site 100% fee for service practice in a rural market right now, and we've got plenty of demand in it. So the fee for service PPO thing is not that big a deal. I will say though, when we talk about like boutique, high-end fee for service practice, personality driven practice, right? Where the doctor's a super producer, super charismatic, big personality. Those type of practices, you might see some trepidation among DSOs because that's a hard doctor to backfill, right? Yeah. So it's got to be, if it's that type of practice in a rural geography, it might be a bigger challenge than if it was, a multi-doc PPO practice in that same geography.
Yeah. Here's a member question. What happens if a fire sale recap takes place And what kind of multiple if the current PE just wants to sell to a new one?
It's very situational, but if there is a forced recap, right, you're going to see a muted multiple. I mean, it depends on the health of the organization. It depends on the environment that we're looking to sell in. You know, today a forced recap may result in a multiple of 8 to 10x. So long as they're not over levered, your equity is still going to be safe, at least from a principal perspective, right? So at least you'll get back the principal. You might not get it back with a handsome return, but at least you'll get it back. And I would say that the worst case scenario that we've seen thus far, none of our clients, just in the marketplace, is that the doctor got their money back. So in other words, I bought $2 million in equity. All I got back was $2 million. I didn't lose any money, but I also didn't make the handsome return that the DSO promised. Now, you know, if things get tougher, right? If we do enter a bad recession, if the DSO was not mindful of how they levered the business and made bad choices in regards to the practices they invested in, and they moved backwards substantially post-close as a whole, I mean, that's when you could be in a scenario where in a forced recap, you could actually see a loss.
Yeah.
So far, so good. We have not had any clients have a loss.
Hey, I know we discussed a couple examples earlier today. Do you happen to have one on you that might just be a single or two doc practice?
Yeah, I mean, well, so I mean, this pattern repeats itself kind of over and over and over again. We have a ton of, you know, $1.5 million to 2 million, 1 to 2 doctor practices that we rep, EBITDA in the 300 to 500 range, in a you know, close to a metro area. Those practices on average are trading for, you know, 5 to 6.5 times EBITDA. So for example, if we had a practice doing, you know, 1.8 million in revenue with 400,000 in EBITDA, and it trades for a 6x, then it's a 2.4 million valuation on a practice doing 1.8 million in revenue, right?
Mhm.
So comparative to selling to a private buyer, that's a home run. And then you have an equity opportunity that hopefully will generate a further return on top of that. So all in, once all your equity is liquidated in that scenario, you know, you might take 3.2 million out of the practice over the course of 5 years. So 1.8 million in revenue, 3.2 million in proceeds, as compared to selling to a private buyer for 1.5 million.
Mm-hmm. Yeah.
It's kind of a no-brainer depending on what your runway is.
Right. Yeah. And of course, like you're still making money as the doctor for those 3 years, but you are giving up some profitability, obviously, you know, given what kind of model you choose.
Yeah. So the point there, and we've actually had this conversation with clients recently, if you're going to take chips off the table, right?
Yeah.
If you're going to cash in all or a portion of the equity in the practice, you're going to take a step back from a personal income perspective.
Right.
We have had some clients, we get into this and they're like, well, I'm going to make less money. Well, yeah, because you got $2 million at close. Of course, you're going to make less money. There's not really a deal structure or a DSO transaction where you can take substantial chips off the table and continue to make the same amount of money that you're making on an annual basis. So that's got to play into it. And something that we do for our clients, Sunny, we always start, first of all, with evaluation. Let's do an EBITDA analysis. Let's do evaluation. Let's get to understand your why. Let's dial all of that in and talk about the result. And then let's run a cash flow illustration to show you on a 5-year window, what is a no sales scenario? So you don't sell the practice now, you own it for 5 years, then you sell it to a private buyer at the end of 5 years. How does that compare to a DSO transaction in a joint venture structure? How does it compare to a DSO transaction in a holding company structure? And let's set all those scenarios side by side by side before we ever go to market to see if the economics work.
Yeah.
If they work, if they're compelling, especially if you have an additional why that, you want infrastructural support, you want to de-risk, whatever it may be. All right, this makes sense. Or if you run through the illustration and you're like, hey, economically, this doesn't really make sense to me. Cool. Let's hit pause. Let's talk about it again in a couple of years. Or let's table it all together. And now you know that, put your head down for 5 years and then see what's available then. None of our clients will ever feel pressure from us to take their practice to market. It's really about an exploratory conversation, an educational conversation. And then once you've got all the facts on the table, let's make a decision.
Yeah. No, that's it's a ton of information. And I think it gets so confusing at times just because there are so many questions to ask. Every client of yours is going to have their own unique set of questions that they want to explore and try to figure out if that's the right thing for them.
Yeah, and you guys are being inundated with marketing from DSOs, with bullshit stories from people on Dental Town. There's just a deafening amount of noise, right? Because there's so much money flowing into this market and so much movement in the market. We've taken the position in the marketplace that our job is to help translate all of that noise and, tell doctors what's real and what's possible. And if it makes sense, great, let's go for it. If it doesn't make sense, let's move a different direction.
Yeah. What is the other type of, I guess they don't call it DSO or DPO or whatever. I don't even know. There's a couple other organization structures out there that claim that they're better than your traditional DSO. Do you work with those selling dentists also?
Yeah. Do we work with those
Or you
DSOs?
represent them? Yeah, I don't need, I mean, essentially, I guess there are DSOs, but they don't want to call themselves DSOs.
It's marketing, man. It's
Yeah.
semantics, right? Whether it's DSO, DPO, OSO, whatever it is, they're essentially all similar, right? They all have a similar goal. They're all typically private equity, family office backed. They're all on a 3 to 5 year recap cycle. At the end of the day, their goal is to make money. They're not an altruistic, charitable organization, right?
Yeah.
So they all are different in regards to their management team, their pedigree, their financial sponsor, their culture, their infrastructure, their deal structure. But, at the end of the day, they're all relatively similar as far as their end goal, if that makes sense.
Mm-hmm. Makes sense. Awesome. Hey, I know we've been talking for a while. Some people actually want to get in touch with you. So I'll post your contact. I'll post your email or cell. Any closing remarks?
No, always good catching up with you, man. I'm here to be a resource to you, to your audience. I think everybody can probably tell I'm super direct to a fault, straight shooter. If you're looking at going down the DSO route, give us a call. I'd love to at least have a conversation, share with you what I know and hear about what you're trying to accomplish and make sure that you make good decisions. If you've got a DSO offer in front of you, happy to weigh in on it, tell you what I know about that buyer, weigh in on the offer. Most of our clients are talking to a DSO already at the time that they call us and engage our services.
Right.
And oftentimes they end up selling to that same DSO, but at a much higher valuation. So would love to talk with anybody out there that's thinking about going down this road. And I appreciate you having me on, man.
For sure. Hey, are you able to answer this one question? Because I think it's actually pretty interesting. What about sales to DSOs in states where only a dentist can own practices? Does that structure kind of change or how the terms are?
So most states, you have to be a dentist to own a practice.
Yeah.
The DSO is really a technical, more so a technical legal structure than it is describing, what the organization, how it actually functions. So a dental service organization is set up in a way to essentially circumvent the law that requires a dentist to own a practice. Technically speaking, anyone can own a practice, but a dentist, only a dentist, can own a patient record in most states. So essentially the DSO is set up to own everything but the patient records. And there's a clinical entity with a dentist involved that is set up to be the custodian of the patient records. The reality, though, is even in those states, one dentist can own 1 million patient records. So a DSO really only needs to have one dentist partner that can be the custodian of those records in order to comply with the law. And even states that have been super, super restrictive, like North Carolina, for a long time would not allow DSOs, have opened up to DSOs. So there is really not a state in the country where a DSO cannot operate.
Makes sense. Cool. All right. Well, it was great catching up with you. Thank you so much. Hopefully, like I said, everyone, taxes are due at midnight tonight, so make sure you guys pay up. So, all right. Thank you guys.
Have a good one, Sunny.
Yeah,
Take
you too.
care.
Thanks.
Bye.